Are rising tariffs and global economic shifts threatening your financial future?
Experts like Danielle DiMartino Booth, Lyn Alden, Snider, and Todd Sachs have analyzed the potential pitfalls and opportunities.
In this video, we've used AI to condense their expertise into actionable insights you can use right now.
First up, Danielle DiMartino Booth discusses the real impact of Trump's tariffs on inflation and consumer prices. Just a quick reminder, this content is for educational purposes only and not investment advice.
Today, we're diving into insights from Danielle DiMartino Booth as featured on Bloomberg's The Asia Trade.
Danielle is a well-known economic analyst. Her perspectives on inflation, trade, and consumer behavior are super important.
She shared critical observations about the potential impacts of Trump's tariffs, current CPI data, and general inflation trends.
Exactly. Danielle really gets into how these factors interplay and affect the broader economy.
Danielle DiMartino Booth discussed the potential impacts of Trump's tariffs on the U.S. economy during her appearance on Bloomberg, The Asia Trade.
Right? She talked about how tariffs could influence inflation and consumer behavior.
She also dove into the latest CPI data and its implications for inflation.
Danielle explored the trends and potential future movements of inflation based on current economic indicators.
Lastly, Danielle provided insights into overall inflation trends and their broader effects.
She connected the dots between tariffs, CPI data, and how these elements could shape our economic future.
Danielle notes that Trump's tariffs could potentially lead to increased costs for businesses, and those costs are often passed on to consumers.
Yeah, these tariffs affect imported goods, making raw materials and components more expensive. Ultimately, this means we might see higher prices on everything from electronics to clothing.
And the impact isn't just about direct costs, right?
Exactly. Danielle points out that tariffs can also disrupt supply chains, leading to delays and shortages, which further drives up prices and affects production schedules.
How does Danielle interpret the current CPI data in light of potential tariff impacts?
Danielle highlights that current CPI numbers don't yet fully reflect the potential impact of these tariffs. She suggests there could be further inflationary pressure down the line as tariffs take full effect.
So we might be seeing only the tip of the iceberg.
Precisely. Danielle suggests we need to monitor upcoming CPI releases closely to gauge the real impact of these trade policies on consumer prices.
What are some of Danielle DiMartino Booth's predictions based on these observations?
Danielle suggests that if tariffs continue without adjustments, we could see a noticeable rise in inflation, affecting consumer spending and potentially slowing economic growth.
And what factors should we watch to validate these predictions?
Danielle emphasizes paying close attention to trade negotiations and policy changes, as these could significantly alter the economic trajectory. Any de-escalation in trade tensions could alleviate some inflationary pressures.
Danielle DiMartino Booth suggests closely watching the Consumer Price Index, or CPI, for signs of inflation.
Right, the CPI measures changes in the price level of a basket of consumer goods and services bought by households. Key insight: inflation can erode purchasing power of consumers.
Danielle also emphasizes monitoring the impact of tariffs on various sectors.
The additional costs from tariffs can significantly influence prices of goods, impacting both businesses and consumers. This is especially true for sectors heavily reliant on imported materials.
Today, we're breaking down David Lyn's insights on how tariffs can disrupt the global economy. David explores the long-term consequences of trade barriers.
David Lyn also brings in insights from Lyn Alden, who is a key voice here. Lyn's analysis helps frame how tariffs erode economic stability.
David examines how tariffs lead to higher consumer prices, reduced trade volumes, and overall economic slowdown.
David also highlights Lyn Alden's points on how tariffs undermine international relations and create uncertainty for businesses.
David Lyn argues that tariffs ultimately harm the economy by increasing costs for consumers and businesses.
He suggests that tariffs act as a tax on trade, reducing competitiveness and leading to economic distortions.
So basically, we're paying more for everything because someone decided to put up walls around the economy.
That's the essence of it. Those walls have consequences.
David Lyn discusses that tariffs often lead to retaliatory measures from other countries, escalating trade tensions.
He points out that trade wars can disrupt global supply chains and reduce overall trade volumes, negatively impacting economic growth.
So at E2M89, it's like a global game of tit for tat. Only everyone loses in the end.
Pretty much. No one wins a trade war, at least not in the long run.
David Lyn emphasizes that tariffs create uncertainty for businesses, discouraging investment and innovation.
He argues that a stable and predictable trade environment is essential for long-term economic prosperity.
So it's like trying to plan a road trip without knowing where the roads go.
Exactly. Uncertainty makes it hard for businesses to make informed decisions.
David Lyn discusses that tariffs raise costs for manufacturers who rely on imported materials and components.
Right. Higher input costs reduce competitiveness, leading to lower production and potential job losses.
So it's like adding a tax on businesses just for trying to make things.
Pretty much, and those costs get passed on to consumers eventually.
David Lyn emphasizes how tariffs disrupt global supply chains, making it difficult for businesses to plan long-term.
Uncertainty discourages investment and innovation, hindering economic growth.
So it's like trying to build a house on shaky ground.
Exactly. You need a stable foundation for any kind of progress.
David Lyn explains that tariffs lead to retaliatory measures from other countries, resulting in trade wars.
Trade wars escalate tensions and hurt everyone involved. It E2M89S a lose-lose situation.
So basically, everyone ends up poorer and angrier.
That E2M89 is the gist of it. No one wins a trade war.
David Lyn projects that continued use of tariffs could lead to a global economic slowdown with reduced trade and investment.
A slowdown could trigger recessions in multiple countries, impacting employment and living standards.
So, we're talking about potentially turning the global economy into a slow-motion train wreck.
Potentially, policies have consequences.
David Lyn suggests that a shift towards free trade agreements could boost economic growth and reduce inflationary pressures.
Removing trade barriers promotes competition and efficiency, benefiting consumers and businesses.
So, getting rid of tariffs could be like giving the economy a shot of espresso?
In a way, yes, it could stimulate economic activity and growth.
David Lyn suggests diversifying supply chains to reduce reliance on single nations. This can mitigate the impact of potential future tariffs.
Exactly. Businesses should explore multiple sourcing options. Don't put all your eggs in one basket, especially when trade policies are unpredictable.
David emphasizes the importance of monitoring geopolitical risks and trade negotiations. Stay informed on policy changes that could affect your business.
Absolutely. Geopolitical events can have significant economic consequences. Keep a close eye on these developments.
Today, we're dissecting Jeff Snider's take on the economic turmoil in India and its wider global implications.
Jeff, known for his expertise in global monetary systems, sees India as a key indicator of broader economic health.
Exactly. He argues that what's happening in India isn't just a local issue, it's a symptom of deeper problems in the global economy.
Right. According to Jeff, India's struggles could be an early warning sign for other emerging markets and even developed economies.
Jeff Snider argues that India is experiencing an economic slowdown that's largely going unnoticed by mainstream media.
He believes this downturn is significant and could have wider global repercussions.
Jeff emphasizes that the problems in India are not isolated, but rather connected to broader global economic trends.
He sees India as a canary in the coal mine, signaling potential trouble for other economies.
According to Jeff, understanding the root causes of India's economic issues is crucial for anticipating and mitigating similar problems elsewhere.
Right. Ignoring the warning signs in India could leave other countries unprepared for potential economic shocks.
Jeff points out that India's export numbers have been declining, signaling a slowdown in its manufacturing sector.
That's a big deal since India relies heavily on exports to fuel its economic growth.
So if exports are down, it's like the engine of the Indian economy is sputtering.
Precisely, and that has ripple effects across the entire economy.
Jeff also emphasizes the significance of the weakening rupee. What's his take on that?
He sees it as a sign of declining confidence in the Indian economy, making it more expensive to import goods and services.
So a weaker rupee makes everything more expensive for Indian consumers and businesses.
Exactly. It's like adding extra weight to an already struggling economy.
And what about consumer spending? Is Jeff seeing any red flags there?
Yes, he notes that consumer spending is down, which suggests that people are becoming more cautious about their finances.
So people are tightening their belts, which further slows down the economy.
Correct. It's a vicious cycle where less spending leads to less growth, which in turn makes people even more cautious.
Jeff suggests that if India's economic problems persist, we could see similar issues popping up in other emerging markets.
Right? Countries heavily reliant on exports or with similar economic structures could be particularly vulnerable.
So India's troubles could be contagious.
Potentially, yes. It's like a domino effect where one country's struggles trigger problems elsewhere.
Jeff warns that a prolonged economic slowdown in India could negatively impact global trade and supply chains.
Absolutely. India is a significant player in global commerce, so a major disruption there would be felt worldwide.
So we could see shortages and price increases for certain goods if India's economy continues to struggle.
That's definitely a risk. It's a reminder of how interconnected the global economy has become.
Jeff Snider emphasizes watching global trade data. Declines there often signal broader economic problems.
Exactly. If goods aren't moving, something's definitely wrong.
Jeff also suggests keeping an eye on leading indicators in major economies like China and Europe.
Right? Because what happens there doesn't stay there, it echoes everywhere.
Today, we're diving into a critical situation impacting Florida's condo market, as highlighted by Todd Sachs.
Todd, who is a real estate expert, discusses the factors turning the Florida condo market into a high-risk environment.
Todd explains that rising insurance costs, structural issues, and stricter regulations are creating a perfect storm for condo owners.
It's a mix of factors that could significantly impact property values and the financial stability of condo communities.
Todd Sachs discusses how the Florida condo market is facing significant challenges that could lead to a crisis.
Todd suggests that rising insurance costs and construction defects are creating an unsustainable situation.
Todd explains that stricter regulations, while necessary for safety, are adding financial strain to condo owners.
This combination of factors is making it harder for condo owners to maintain their properties and finances.
Todd Sachs points out that many Florida condos are facing latent construction flaws, leading to extensive and costly repairs.
These flaws often go unnoticed for years, only to surface later, resulting in special assessments for condo owners.
According to Todd, stricter regulations following events like the Surfside condo collapse have increased scrutiny and compliance costs.
These new regulations mandate more frequent inspections and stricter reserve requirements, adding financial pressure on condo associations.
Todd highlights that many condo associations are struggling to maintain adequate reserves, making them vulnerable to unexpected expenses.
This lack of financial preparedness can lead to significant special assessments, burdening condo owners with unexpected costs.
According to Todd's discussion, some condo associations are facing challenges in securing loans for necessary repairs due to their financial instability.
This can delay critical repairs, further exacerbating the structural issues and potentially devaluing the properties.
Todd Sachs suggests that if the issues aren't addressed, some condo owners may face distressed sales due to the inability to afford rising costs.
This could lead to a decline in property values as more units flood the market, creating a downward spiral.
According to Todd, condos with significant structural issues and underfunded reserves may become increasingly difficult to sell or insure.
This could further isolate these properties, making them less attractive to potential buyers and investors.
Todd Sachs advises condo owners to reassess their financial planning, considering the increased costs and potential risks.
Right? It's crucial to factor in higher insurance premiums and potential special assessments into your budget.
Todd also emphasizes the importance of staying informed about the financial health and structural integrity of your condo association.
Definitely. Review the association's financials, attend meetings, and understand their plans for addressing structural issues.
Today, we're diving into the insights of Jeff Booth, a technology entrepreneur and author, on the vulnerabilities within the current financial system.
Booth offers a critical view of fiat currency and argues that the system is inherently flawed, leading to inevitable collapse.
His analysis centers on the idea that the system is rigged to fail, primarily due to its reliance on ever-increasing debt and inflationary policies.
Exactly. Jeff suggests that this creates a situation where the value of currency is continuously debased, ultimately harming individuals and the economy.
Jeff Booth's core thesis is that the current financial system is inherently flawed due to its dependence on debt and inflation.
He believes this system is rigged to collapse, benefiting those who control the money supply at the expense of everyone else.
According to Jeff Booth, Bitcoin offers a potential escape hatch from this system due to its decentralized nature and limited supply.
He sees Bitcoin as a hedge against the inevitable debasement of fiat currencies.
Jeff Booth suggests that understanding the underlying technology and economics of Bitcoin is crucial for individuals to protect their wealth and navigate the changing financial landscape.
He emphasizes the importance of taking personal responsibility for financial decisions rather than relying solely on traditional institutions.
Jeff Booth argues that fiat currencies are inherently unstable because they can be created without limit, leading to inflation.
Right? He points out that this constant printing of money devalues existing currency, reducing purchasing power over time.
Booth contends that the reliance on debt to fuel economic growth is unsustainable, as it requires continuous borrowing and increasing the debt burden.
Yes, he emphasizes that this creates a cycle where more debt is needed to maintain the same level of economic activity, leading to eventual collapse.
Jeff Booth highlights that central banks' interventions, such as quantitative easing, only exacerbate the problem by further distorting markets and incentivizing reckless behavior.
Exactly. He suggests that these interventions create artificial bubbles and misallocate resources, ultimately undermining the long-term health of the economy.
Jeff Booth proposes Bitcoin as a potential escape hatch from the flawed financial system, citing its fixed supply and decentralized nature.
He believes that Bitcoin's limited supply of 21 million coins makes it resistant to inflation and devaluation.
Booth argues that Bitcoin's decentralized structure eliminates the need for intermediaries, providing greater control and autonomy to individuals.
Right? He suggests that this reduces the risk of censorship and manipulation by governments or financial institutions.
Jeff Booth emphasizes that understanding the underlying technology and principles of Bitcoin is essential before considering it as an investment.
Yes, he suggests that this knowledge is crucial for making informed decisions and avoiding common pitfalls.
Jeff Booth predicts that if the current trends continue, we are likely to see further currency debasement and increased economic instability.
He warns that this could lead to hyperinflation and a loss of confidence in traditional financial institutions.
Booth anticipates that Bitcoin's adoption will continue to grow as more people seek alternatives to the flawed financial system.
Right? He suggests that this increased adoption could drive Bitcoin's price higher and further establish its role as a store of value.
Jeff Booth suggests that understanding the flaws in the fiat currency system is crucial for making informed financial decisions.
Exactly. He emphasizes that hyperinflation or currency debasement are real risks that individuals need to prepare for.
Booth advises considering Bitcoin as a hedge against monetary debasement and a potential escape hatch from the existing financial system.
Right? But it's not just about buying Bitcoin blindly. He suggests understanding its underlying principles and technology before investing.
Jeff Booth stresses the importance of individual responsibility in managing finances and understanding the changing economic landscape.
Yes, relying solely on the existing system might not be enough. Being proactive and informed is essential.
Wow, what an incredible array of insights from our panel today.
Absolutely. Jeff Booth, Todd Sachs, and the others really challenged our thinking.
It's fascinating how they all recognize technology's disruptive power.
Right? But then there's that divide. Booth views tech as a complete game changer, while Sachs emphasizes infrastructure.
And we can't forget about Jeff Snider's caution about relying too heavily on monetary policy for recovery.
Exactly. It seems the guests agree on the need for diverse investment strategies, but they see the paths to growth quite differently.
If you found today's discussion enlightening, make sure to hit that like button.
And don't forget to subscribe. We promise to keep bringing you more expert insights like these.
Stay tuned for our upcoming videos where we'll continue unpacking the complexities of the financial world.
Thank you for watching, and we can't wait to see you next time.